Hello there, fellow classmates. We are here, again, at another awkward recording where I'm going to pretend like I know what I'm doing. For the problem that I'm doing today, which is exercise 13 of chapter 10, we're going to do some bonds. We'll do some bonding as well between each other, and then we'll document them, journalize them, and we will also do the same for the interest on the bonds. So here we are. Got my reference up, and here's my embarrassing Excel spreadsheet. Please don't judge me. I'm not going to be doing any shortcuts because I am not familiar with them. All right. So here's the information we got here. Crane Company issued $520,000, yes please, of 8%. 20-year bonds on January 1st, 2017, and the beautiful part about this is it is at face value. That means less math. Interest is payable annually on January 1st, which is important for us a little bit later. Okay, so to start off, it wants us to prepare the journal entry to record the original issuance of the bonds. Pretty simple. We just do that at the being again face value. We're going to use the 520,000. We're going to debit our cash for that 520,000, and then our bonds payable to balance it out. Maybe I can learn how to spell while I'm doing this. We'll go ahead and credit our bonds payable, our current asset, for another 520,000. All right, pretty simple. Having it at face value makes it easy. So, second step, prepare the journal entry to record the accrual of interest on December 31st, 2017. So to do that, we will debit the expense of the interest with a wee bit of math here. Again, at face value makes it simple. 520,000, and we know it's at 8%, and that gives us 41,600. So we'll debit that expense, 41,600. Just kidding. And then we will also debit the interest payable of 41,600. Okay. So we're documenting the accrued interest on December 31st. So that's pretty simple for this step. Then we come down. Now it wants us to record the payment of the interest. So this one, we're going to pull from our interest payable for the same amount, 41,600. And then in order to debit the interest payable, we need to balance it out on the other side, and we're going to pay it with cash. Okay, of 41,600 again. So pretty simple. This is recording the interest, and this is the actual payment of the interest. Now prepare the journal entry to record the redemption of the bonds at maturity, assuming interest for the last interest period has been paid and recorded. So if we look at our reference, see if I could find it. If we go to the redemption, what it ends up telling us is upon redemption, goodness, let me do my little cheat here. Okay, regardless of the issue price of bonds, the book value of the bond at maturity will equal their face value. So remembering this is key, because this will save you a lot of time. Is remembering that the bond at face value, or excuse me, at maturity is equal to the face value. So simple enough. Bonds payable is what we're going to debit for the full amount. Face value 520,000. And then in order to do that, we're gonna credit our cash of 520,000 because we need to have it balanced on both sides. And yeah, that's pretty much it. I hope I did a decent job explaining this. This was, again, pretty simple just because of the information given. It not being at a premium or a discount, you just pull straight from here and use our percentage for our interest. So yeah, I definitely recommend using the references because that's what I did here. It's as simple as taking the idea, or I guess the steps here, and applying them here. So yeah, if you have any more questions, please leave comments. I know I'm not the best at explaining things, especially when I'm live and on the spot, but I can respond to any comments that y'all put. So let's get through this together, guys. Good luck on your exam if you haven't taken it yet. Actually, when this is up, you better have taken it. Thanks. Bye.